All right, and we are back, and welcome to Option Pit. And today we're going to talk about a little bit about delta neutral trading, and that's creating income with options. One second. So today, so let's start by just learning a little bit about me. I'm the guy on the left. That's Liz Clayman. Nice lady. Really friendly, had kind of a potty mouth, which I was a little surprised by, but really, really, really nice lady. I was a trader on the floor for, a good, almost a decade, and then I trade for myself, and on top of doing education, I do a lot of consulting work with hedge funds. So hedge funds and money managers, stuff like that, will bring me in to help them implement option strategies or test to see what their option strategies are doing wrong. So I do stress testing, I do implementation, stress testing, and risk testing on large-scale option strategies. So I like to say that I've had clients with $5,000 in the bank, and I've had clients with $15 billion in the bank. And I treat them all the same. So what you will learn, you're going to learn that in selling options, traders can run their own insurance company. All right, and this is kind of the theme of my book, which is the Option Traders Hedge Fund. It's the one-man insurance company. All right, so we're going to talk about how do insurance companies make money, how do options relate to the insurance business, how to identify under and overpriced options, conditions of volatility that produce optimal conditions for a specific trade, and then I'm actually going to walk through an example of a trade from today. So I pulled up end-of-day charts, and we're going to analyze and break down and kind of come up with what we think is the best trade. All right, the insurance business. All right, insurance make money selling insurance policies to many individuals. All right, the idea is that only a fraction will redeem at any one time or redeem at all. I know a lot of insurance salesmen. I really do. And, the thing they always tell me about term policy, everyone know what term life is? Everyone know what term life insurance is? It's life insurance where you pay as you go, and it's for 20 or 30 years. And if you, one, stop paying, or two, it goes past the 30 years, you don't get anything. Well, the reason why it's so cheap is because nobody redeems. And that's really what you're trying to do. That's really how insurance companies make money. A fraction redeem, or if any redeem. All right. So then that excess capital is used to invest. All right. The risks are spread out over a large area. All right. And to reduce their risk further, they'll go out and buy insurance back on the reinsurance market. All right. So there's insurance, and then the insurance companies engage in reinsurance to protect themselves. It's like insurance on the insurance. All right, so there's all these different layers of insurance that insurance companies engage in. Options are just the same. Insurance policies collect dollars up front for obligations to pay a claim later. All right, selling options generate a credit up front for taking the obligation of buying or selling the underlying security at a set price in the future. Sounds pretty similar, doesn't it? You're selling something now, taking the money, and you're going to get a set price in the future. So let's compare. So insurance companies engage in underwriting and pricing, and that is going to be for the option trader, that's the trade selection. Then they enter into reinsurance operations and claims processing. That's a trader's risk management. Then customer acquisition and investment operations, really. And that is the trade execution. All right. Adapting option trading to insurance model takes some adjusting, though. They're not exactly the same. All right. All right. So comparing options and insurance. All right. So you've got to, in the trade selection part, you have to think about market selection. You have to think about pricing. You have to think about strategy selection and the time frame. All right. The risk management is positioning. All right. Money management. All right. How much are you putting into each trade? Trade adjustments. So the trade goes bad. How do you manage the portfolio? Buying of options. You sell a lot of options. The reinsurance is buying options back, and or buying a long approach somewhere else. Closing positions. That is a discipline. All right. Insurance companies close positions all the time. And of course, diversification. Right? What kind of insurance are you selling? All right. Are you selling insurance in just life? Are you selling term and whole life? Are you selling, are you selling auto? Right? Are you selling in only big names? Are you selling in small names? Are you selling in only equities? Are you buying stuff? That's your diversification. All right, and then trade execution, route selection, strike selection, complex versus individual orders. All right, so that's how you execute the trade and manage in and out. All right, so now under these, all right, like everything else, there is some support functions. The insurance salesman, do insurance salesmen, are they all their own people? Is it just, oh, I'm an insurance company person, I don't need anybody? No. All right, they have support. They have their admins. They've got their back office. They've got their actuaries. They've got all sorts of people that do this stuff besides just being insurance salesmen. So your infrastructure and support is building your trading plan. All right, so that is what is my approach when I sit down every month and I've got nothing on? What do I do? Your trading infrastructure. All right? What are your methods for executing and managing? How do you back test? All right? And then learning processes. All right? So how do you get to, what are your ways of checking that you're doing things the best way? And this is the kind of a mistake a lot of traders make. All right? They think just because they made money, they did things the best way. Okay? I mean, that's the hilarity. All right? Just because you made money doesn't mean you did things the best way possible. All right? And that's often a mistake. All right? So even if you make money, you go back and do a post-op. How many people do that? Not many. All right, markets. what markets to trade. First, how do you tell if an option is fairly priced? All right. Yeah, no, not a lot of people do that. Oh, I made money, so it must have been the best way to do it. Not always. In fact, almost never. You know, we spend a lot of time thinking about what we could have done better on our losers. We don't spend a lot of time thinking about what we could have done better on our winners. All right. So, how do you tell if an option is overpriced? Well, remember, insurance brokers sell overpriced policies. Every policy you buy from a broker is theoretically overpriced. All right? Now, most options are also overpriced. All right? So, the question is, how do you evaluate whether an option is a good sale or not? Most of the inputs of an option model are known at the time of execution, but not all. So insurance companies use actuarial tables to compute rates for policies. So they got all this statistical analysis done of, you know, you're this with this condition and this. So here's theoretically how long you're going to live. Here's what your policy costs. All right? Don't we wish option trading was that easy to, and we can make money doing it that way? I wish. Just doesn't work that way. All right. Option traders use the option model, Black-Scholes is an example, to price options. All right, and that has the 5 factors in every model. All right, and that's cost of carry, stock price, strike price, timed expiration, forward volatility. All right, these are the major factors that determine the price of an option. All right, so let's talk about the inputs and what we know and what we don't know. Cost of carry. Most of us can figure out cost of carry. What's the cost of carry right now on anything? If it's not hard to borrow, what's the cost of carry on a stock, essentially? Yeah, zero. Zero. All right. The strike price is known. You know, what level are you, you know, what option are you selling? Yeah, we know the strike price. We know the stock price. We should know the timed expiration. Although, you know, it was funny. I was doing a TV interview, and I was having a conversation with the guy that works in the control room. And I'd gotten this card. And it was a coupon for $11 off my next meal. And the coupon said $11 off your next meal expires February 30th, 2015. Now, does anybody know what was wrong with that coupon? Yeah, can something expire on February 30th? No. Well, the funny thing is the guy didn't know how many days were in February that I was talking to, the control booth guy. I said, how do you not know how many days are in February? Anyway. But anyway, for the most part, we know the time. All right. Now, finally, we have forward volatility. All right. And forward volatility is not something we know. All right. We don't know the forward volatility. All right. If you knew the forward volatility is how much something's going to move in the future. Good luck. All right. So finding the forward volatility. All right. This is 2 different volatility charts that we're going to talk about in detail overlaid. All right, the blue line is 20-day historical volatility, sometimes called realized volatility. The red line is 30-day implied volatility. All right, so what's the difference? The blue line is how much the market has moved over the previous 20 days. All right. Now, does anybody know what stock this is a chart of? If you can guess what stock this is a chart of, I'll send you a copy of my book for free. Dick Blythe, email me. You are a winner. You are the first. You are the winner. The answer was, in fact, Apple. So Dick Blythe, email me, mark@optionpit.com. Probably should have said the first one, but that's what I meant. I'm not an endless supply of free books, unfortunately. Did not publish on Amazon. I am owned by Financial Times. But yeah, this is Apple. All right, so the red line represents how much Apple has moved over the previous 20 days, the blue line. So this spot right here basically says that in the past 20 days, Apple has been moving at an annualized rate of a little under 30%. Now, the red line is implied volatility. And the red line is basically saying, here's how much we think the market is going to move on an annualized basis over the next 30 days. All right? So the red line is saying that the market thinks Apple is going to move at a 24% volatility over the next 30 days. All right? So we're going to come back to this chart. I just want to make sure. The market is betting how much Apple is going to move. So the question was market or Apple. So the red line represents how much the marketplace, the worldwide marketplace, thinks Apple is going to move over the next 30 days on an annualized basis. All right. At the money implied vol is the market's best guess for forward volatility between now and expiration. But is it correct? Let's look at that previous chart with the fresh eyes. All right, let's look at that again. So let's look at, January 16th. All right. January 16th, that's not right. It should be 23. That's incorrect. That's from an old chart. This is from today. January 16th, the market was betting that Apple was going to move on an annualized basis at over, 38%. Now look at the blue line. Does the blue line ever get as high as where things are on January 15th? All right, right here. Does the blue line ever get as high as these 2 points? No. If I go back 20 days, here we are February 16th, or February 17th, right? So about 20 days is going to be January 16th. Well, guess what? Over the last 20 days, we moved at about a 30% IV, a 30% volatility, excuse me. So right here, this blue point here is what the market is, the kind of net of what the market was guessing here. That's a pretty big spread, isn't it? If I could sell, if I could sell 38% volatility on something that I know is going to move at 29%, do you think I can make money? Yeah. So it's all about recognizing when those policies are out of whack. And then fitting the right trade to that out of whackedness. All right, finding overpriced options. All right, so if you look at the realized and implied, you got to look for the trend. All right, is the policy too expensive or too cheap? There are times where policies are too cheap. All right, so understanding when something is expensive or something is cheap is the first step toward trade selection. You know, it's something I preach, is recognizing when volatility is low or volatility is high. Essentially, when is a policy overpriced, when is a policy underpriced? All right, what to ask? What is the current realized volatility SPX or whatever? All right, how much is the market actually moving? All right, make sure you interpret the HV the right way. Look at the data set for large outliers. Look at several periods for trends. All right, you know, have you ever seen one of those days where the market is up $30 and then down $30 and then closes unchanged? Anybody remember? Anybody seen with some of those days where we have a huge intraday move? Yeah, those are not picked up by a standard Garch volatility chart. The type that are on for historical volatility, the type of charts most companies use will not pick up intraday moves, or excuse me, intraday moves. It registers as actually low volatility. All right, look at several periods for trends. So I mean, you look. This is an older chart. This is from a while back, but you know, look at the different ways that volatility moves. You know, it moves in these big waves. But there are low points and high points within this data set. This is about a 6-month data set. All right, and that dark blue line represents 60-day realized volatility. How much the market is moving on a 60-day basis. All right, now we're starting to get into some of the meat here. All right. There are trends. There are points where one should be buying or selling options, or at least recognizing that realized volatility is going to turn around. You know, so for instance, you know, if I look at this chart, what do you notice here? Does anybody notice a little trend in the 10-day? Take a look at the 10-day, the 20, and the 20-day, and even the 60-day. Anybody notice a trend in volatility. Take a look at the lows and the highs. What's happening with the lows and the highs? Yeah. You're getting a chart that kind of looks like that. Should that mean something to you? This is the S&P 500. It is not earnings related. This is the market telling you something. All right. So now let's talk more about how to look at stuff. All right. 10-day HV is too short to evaluate actual HV level, but can clue us into what is exactly happening recently. Was there an event that just happened that is affecting historical volatilities? All right. 20-day HV is 1 month of trading data. Because remember, we don't trade on Saturdays and Sundays. It's good for, I think it's really good for looking at a snapshot of, okay, what's really happening? All right. Now, 30-day HV has a lot less noise than 20-day. It's good for traders who trade more part-time than full-time to see kind of current trends. And then 60-day HV, I think, is the best picture of the current long-term trend in the market. You should see the long-term trend. So if we go back and you just kind of look at the blue one, you really see kind of the long-term trend. Somewhat flat, but meandering higher. So the question is, but the option pricing is a function of IV, not the HV. So the cycle of HV has nothing to do with the option pricing, correct? That is correct, but does the success of the option trade have something to do with HV, or how the market actually moves? Right? Does implied volatility determine the success of an option? No. Does historical volatility determine the success of an option? No. What implied volatility tells us is, here's how much the market is betting this option is going to move. What historical volatility tells us is, here's how much the market's been moving. When those two are out of whack, either one has to give, correct? Either if implied volatility is way too high, either the market is going to move or implied volatility is going to fall. What do you think happens more often? Anybody can answer this. Yeah. On average, in the S&P 500, implied volatility is 2 to 4% too high. This is in the biggest index in the world. The most actively traded, closely followed, institutionally vested product in the world. And it is 2 to 4% too expensive on average. Now, does that mean when IV gets too high, we should go hog wild and just sell everything? No. But it's something we should pay attention to. So, for instance, if I see a trend like this, and I see implied volatility, and we've had a little bit of a sell-off, but I see implied volatility too expensive, guess what? You think I'm as excited to sell it? I'm gonna be looking for something to buy almost as soon as I sell this. I'm gonna find something. Oh, I just eyeballed that. Someone was saying, how or what were you looking at to get the slope of the red line? I just eyeballed that. That is not nowhere near accurate. But I'm kind of, if I really wanted to get the slope, an accurate slope of the red line, I would probably be looking at something that looks more like this. Something like that. And I'm not a great dar. As you can see, the white line represents 10-day HV. The light blue is 20. The gray is 30. And the the purplish color is 60-day HV. All right. So now, in addition, and this is where we can really sometimes get some huge clues. Always look at a price chart to see if there's something not coming through in HV, like large intraday moves. So now let's talk about a trade that's really going to be affected and is going to be successful because of realized volatility. All right, falling versus rising realized volatility is going to be the #1 determiner for how strangles, condors, and credit spreads perform. If you are a credit spread seller, the #1 thing you should be watching is how, or trading off, is how you expect realized volatility to move. All right. #2 is implied volatility. All right. So, we have this kind of checklist of different things, and I'm going to cover three of the five main things I work on and I really look at. I'm going to discuss tonight. We only have an hour. And actually, I'm going to have trouble getting through an hour. I'm on slide 20 of 35. Falling versus rising volatility is going to be the #1 determiner for strangles, condors, and credit spreads, whether they're successful. All right. So what I mean by that is, what is your expectation for realized volatility? If that is correct, a strangle, a condor, a credit spread are going to be your most likely to succeed. The second one you look at is, obviously, is the IV overpriced relative to that expectation, or underpriced for that matter. Now, if IV is underpriced, we're going to talk about that. All right. Implied volatility is how much the market is expecting the market to move over a period of time. All right. And over the very long haul, so in 5-year shifts, it does mean revert. All right. It's more useful to look at kind of the relative median than the relative mean. All right. And IV moves, actually, implied volatility, the VIX, moves in cycles within cycles. I like to say kind of cycle 1 is really low volatility. Cycle 2 is medium low volatility. Cycle 1 and cycle 2 represent about 70% of all volatility scenarios, implied volatility scenarios. Cycle 3, relatively high volatility, call it, 17 to 21% that we're kind of in now. And then the itty bitty bitty piece of volatility is the kind of panic volatilities that we see. Those are the main cycles of volatility. All right. 90-day volatility is based on 90-day IV. Anything that says implied volatility is forward-looking. All right, and what 90-day IV represents is what an option with 90 days to expiration is pricing the movement for the underlying instrument. Does anybody know the kind of 90-day-ish volatility index for the S&P 500? It is, no, not the price. What is the symbol? You know, the VIX is 30 days to expiration, VIX. VXX is a volatility ETN based on the futures. It is not an index. So we have the VIX that is the 90-day, or the VIX is the 30-day volatility instrument on the S&P 500. VXST is a 9-day instrument, but there is a what is a 92-day instrument. I'll give you guys a guess as to what the first letter is. What do you think the first letter is? It is a number after, it is a letter after U and before W. Yes. The instrument is VXV. All right. And you want to know a little tidbit? All right, I'm going to give you a little long tidbit. All right. There is one of the worst, one of the best ways to tell if the market has negative expectancy is by looking at the ratio of VIX to VXV. If all you did was go to cash when VIX rises above VXV, and then go back into the S&P 500 when VIX is back below VXV, you would dramatically outperform the S&P 500. All right, so one more time. If all you did was go to cash when VIX was greater than VXV, and then went back in when VIX crossed back below VXV, you would dramatically outperform the S&P 500. All right. Now, use the exact durations to look at what is going on. All right. 30-day IV is a guess at what might happen soon. Why doesn't everyone do that? Because most people are too lazy. What was 9-day vol? VXST. Honestly, we've done all these studies and white papers, Russell, Rhodes, and I. We've got a bunch of different white papers out there on selling puts and doing out-of-the-money calls against stock and all the ways that they outperform over, and our study's 26 years. And we're just like, we got to be missing something. Why doesn't everybody do this? And then the answer is just people are lazy. Over and over and over again. You know, the only thing that, you know, is greater than the stupidity of the average investor is the laziness of the average investor. Which is why I'm so proud that all of you are here. Because it immediately means you're not average. All right. So use the exact durations to look at what is going on. 30-day implied vol is what might happen soon, and 90-day IV is kind of represents long-term trends. So here is the green is the 90-day IV. The red is 30-day IV. And you can see how these things cross. Very rarely. And only, when do these things cross? You notice this? When do they cross? What is the market doing? Panicking. All right? Going long when the market is panicking is kind of like trying to rescue a drowning person by swimming to him, rather than trying to give him a stick or a pole. All right? You're going to rescue, 70% of the time you're going to rescue them and nothing will work out, and everything will work out fine. 30% of the time, they might take you down with them. Absolutely. So the question is, are you selling option premium at peaks? Sometimes. That is probably not. That's not the point I want to get across here. I actually prefer, and actually there's a more positive expectancy in selling option premiums during these periods of time when they're real. Now, you see what's going on here? That's when the stuff's juicy. Because guess what's going to happen over the next 60 days? Where do you think this is going to end up? So let's look. All right. So here's the option premium at 90 days in April. All right. Where's the option premium at 60 days? Maybe here. Or at some point, it'll go here. Exactly. So the number one determinant, so buying options at lower levels, selling them at peaks, then, no, it's just not that simple. Really, what you're doing is selling options when implied vol is high, the market isn't moving very much. Which is, believe it or not, usually when implied volatility is somewhat low. Implied volatility is at its most overpriced when IV is low, not when it's high. So the number one determinant of a straddle or a butterfly of butterflies and debit spreads profitability is the purchase price, which is derived from IV. Secondarily is realized volatility. Typically, so the question, say that again, typically implied volatility is actually at its most overpriced when volatility is overall low and we get a small bump in realized volatility, and realized volatility falls off and implied volatility stays a little high. We're kind of in one of those periods right now, I think. Do I run this study for each stock? Yeah, every stock you want to trade, you have to look at. My favorite screen, my favorite one to look at, I love looking at this chart. This is the chart. When I'm trading, this is the chart I'm always looking at. What is realized volatility? Where's 30-day implied? Looking at this chart, I can derive trades. All right, so now final thing we're going to talk is term structure. All right, is 30-day implied vol below or above 90-day implied vol? All right, if 30-day is lower, or in what we call a contango, it denotes a calm market. It should be considered a logical market. That is when it is reasonable to trade. All right, I do not enter your standard premium selling trades like condors, butterflies, short strangles, whatever, when front month vol is higher than back month vol. It denotes that the market is not in its, all right, does not have its wherewithal. All right. All right, the market is somewhat reasonable. We're actually going to look at it in Facebook. So when the market is reasonable, that's when I'm looking for trades. All right, if the market is in kind of an IV backwardation, so 30-day IV is higher than 90-day IV, the market is less than logical. All right, that means you're going to see these huge swings. I mean, think about some of the moves that we've seen. All right, you know, one thing that might surprise many of you, since the beginning of December, has the market been more volatile on sell-offs or on rallies? What do you think? All right, over the since December, has the market been more volatile on rallies or on sell-offs? Yeah, the answer is rallies. Rallies have been about twice as volatile as sell-offs since December. So you're looking at that 30-day IV or that 90-day IV, and you're saying, oh, wow, look how illogical the market is. That premium, oh, I should sell an iron condor or I should sell something, right? Well, guess what happens? You sell an iron condor or, a combination of credit spreads or whatever, and the market rallies so hard it blows through your upside strikes, not your downside strikes. All right? That is why you don't do traditional trades into a super illogical market. There are things to do. There really are. Lots of great things to do. All right? But it is not selling your kind of standard plain vanilla spreads like an iron condor or something like that, your average Tom, Dick, or Harry that teaches options is going to say, oh, you do this. And the reason why is when VIX is over VXV, assumptions are less likely to work. About the only trade that's plain vanilla I would think about in that environment would be a credit spread or like a calendar spread. And even calendar spreads are dangerous. All right, within contango and backwardation periods, there may be time where options seem under overpriced in one month or another. Look at current mean relationship levels. If the VIX has been trading at 1 point under VXV for the last 90 days, and then moves to 2 points under, something has changed, right? So if VIX minus VXV has been -1 for 2 months, and then all of a sudden VIX minus VXV is now -2, something has changed. If you recognize something has changed, that is a chance to pounce. Traders looking to sell premium or buy premium can really move around volatility. Term structure is going to determine how calendars, time spreads, diagonals, and double diagonals perform. So now, let's analyze a trade in Facebook. All right, we're going to look at Facebook, and we're going to figure out a trade that looks interesting to us. And I'm going to kind of ask you guys. All right, so what do you think? So what do you think? Let's look at the stock chart first. How's volatility moving around? Yeah, it looks like a little bit of a consolidation. Smaller candles, keeps bouncing off the 50. Certainly is well above the 200, and outside of this one pop, looks like it's trending a little higher, right? Range bound, trending a little higher. Now let's look at HV. So what would you say is the trend in historical volatility? Oh, way down. All right, so we've got somewhat range bound, and we've got historical volatility tanking. Now, let's look at HV, or IV, implied volatility. So what is implied volatility doing? Well, I will tell you this level right here, it's one down. Now, but remember, what does volatility do that's different from everything else? It reverts, all right? Yeah, it mean reverts. So what if I tell you that this represents the lowest implied volatility we had seen in Facebook in the last 4 to 5 years? Basically, there was one more period of time where it went public. Since it went public where it got lower. The green line is 90-day implied vol. All right? So the red line represents that 30-day implied vol. So that's term structure. So what we've got is term structure tightening up. We've got the lowest implied vol we've really seen in some time and sinking realized volatility. So let's go through that checklist. All right? We've got the price action is bouncy but consolidating. We've got HV that continues to fall. All right? And we've got IV that is low, and we've got a term structure that is in contango but in a tight contango. Right? When you say this is relatively tight, relative to a lot of the other periods, especially fresh out of earnings. So we've got a relatively tight contango, which means back month vol is not that expensive relative to front month. We've got low implied vol. We've got sinking HV. and we've got consolidating. Yeah, I mean, I agree, but I would do it a little differently. So now we have, so it's not that easy, right? How many different trades could you guys think of that maybe fit most of these? And Vince, I'm going to give you a better trade, I think, than selling a put. What trade do you think I'm going to say? One of these trades is not like the other. One of these trades is kind of the same. Is not quite the same. It's certainly not going to be a naked call. In fact, about the only trade I never would do is a naked call. A call fly is not a bad idea. That was actually my second choice. I want a trade that does well in low HV but has exposure to long implied volatility, but is not going to be penalized by the somewhat negative term structure. So thus, I come up with that long diagonal spread. A long diagonal spread. All right? So I've got long Vega exposure. I've got short premium exposure to HV. And I've got less term structure risk because of the difference in strikes. So let's look at the risk chart. I am long Vega. And so if we fall 2%, which is 74, that's about as low as we've seen in Facebook, right? 74 is a relatively safe level. And IV rallies 20%, which is just like 4 or 5 points. I'm still break even. See that? And this is the trade that I decided on, and I'll show this to you on the risk chart. And then if we rally and vol goes up, I make a lot more. And if we sit here, I do great. So this is like a credit spread, except it's long Vega. I'll show you what it looks like here. All right. Oh. You guys still see my screen? Oh. All right, I pulled up Live Vol X. So this is the trade I pulled up. It's the April 72.5, March 75 put spread. So I'm selling the March 75s, buying the April 72.5s. I'm collecting a credit on this spread. Now, what's the best part about all this? On top of the fact I collect that credit, when March rolls off, what can I do? Does Facebook have weeklies? A more advanced trader would do this as a bunch of weekly spreads, like I would. That's how I would do it. So here's the trade. I've got I sold the March 75 puts versus the April 72.5 puts. Collect, theoretically I collect about 16 to 20 cents. All right, and I've got and so if it stays above 75, I do well. And if I pull it up on the 3-day risk chart, here's that risk chart again, you can see what it looks like. And I'll show you 25%, 50%. You can see how this thing works. This is a great spread. With the vol this low. With the vol 1 point off of essentially a 3-year low, I don't mind owning some Vega here. The next trade I looked at was actually a butterfly. These were puts. And do not take this as a recommendation. This is for education purposes only. Oop, wrong slide. You guys are seeing my we'll go back to monitor 1. All right, so you guys all able to see it? All right. Yeah, the next trade I would have done would have probably been a butterfly. That's actually would have been my next one. So in summary, the insurance make money by selling premium for more than it's worth. Option traders have to find premium that is trading for more than it's worth. Learn to read price, HV, IV, and term structure, and use the information the market is giving the trader to find the right trade. All right? So, hopefully you liked today's presentation. All right? And honestly, if you've got some input on it, I would love to hear how I can make it better. All right? So, on February 28th, all right, that's February 28th, so call it 11 days from now, I'm going to be doing a special, call it a 3 to 4 hour Saturday class called Creating Income Using Option Spreads. And while this was, I think, gave some real nitty-gritty, if you want really in to the super nitty-gritty, you know, how to manage and execute and really control and decide every trade, this is about the best few hours you could spend. All right? Now, on a normal Saturday class, I would charge $247. The class today is just $147. Yeah, I'll email out a recording for sure. All right, of today's class and this. Now, I'm going to record it if you can't make it on that Saturday. You go to optionpit.com/income. All right, and now here's the best part. There's a lot of, here's the best part. If you attend the class or even watch the class, I'm going to give you a secret word. And if you email me the secret word anytime within the month of March, I will rebate you $30. So it'll only cost you $117. And you're going to learn all about the volatility cycles of a stock, how to integrate volatility in stock charts at a real intuitive level. All right? I'm going to teach you really in detail every spread that you can think about. You know, how to master those conditions. So if you thought that kind of ending example, we're going to kind of hit that with the butterfly, with the condor, with the straddle, and with credit and debit spreads, along with diagonals. All right? And then I'm going to really teach you about risk management and when to buy options and and some important tips on managing a book. So that's February 28th. All right? And again, just $147 for 3 to 4 hours, so a lot of time. It will be recorded, and you get to keep the recordings for yourself. All right, so go to optionpit.com/income. Any questions? If I did the butterfly trade, what's the max time I would go out? I like my butterfly trades with relatively short duration. And in fact, most of my butterfly trades are broken wing. So a trade like that, if I was going to do it, I would probably have done the March 75, 80, 82 and a half. Something that got me long a little bit of premium. Oh yeah, what chart do you want to see? All right, so I'll show one extra chart, and we'll show Goldman Sachs. Well, all right. That's It's not a bad idea, but I think there are some different ways I might do. That's probably going a little to excess. So we can look at a chart. And here's Goldman. All right, now, one thing we know, what do you think, what kind of trade do you think I was doing down here? You know what I was doing? Buying straddles. Now that we're here, I'll be honest. This looks like a, there's not that much to give on the 90-day and a lot to give on the 30. I might look at a calendar spread here. All right, well, let's look at the underlying. Underlying's had a big move. I need to see a little bit more, but it might be consolidating. And then obviously I'd need to see that chart. You can see, ooh. That's been a steady rally, but near term, well, it looks like near term volatility is starting to fall, but is on a steady rise higher. Okay? From a term structure perspective, term structure is relatively tight. And if HV is falling, and I think IV is going to fall, I've got a relatively decent floor of maybe a point or so in 60 to 90 day, and quite possibly 30 day could completely drop to the floor, drop into the 16s. In addition, like I said, I'd want to see a little more, but it might be consolidating, which would mean I'd be looking for long theta. Maybe a double calendar, something around it. So like the 85-95 double calendar might make sense. So again, I really hope you guys take advantage of my offer. And if you got questions, feel free to email me, marketoptionpit.com, or call us, 888-TRADE-01. And I want to thank you. Again, if you guys have any really meaningful comments other than, hopefully like it's not just you suck. I'm sure I'll get one, but something along the lines of, I really liked when you explained this, but I didn't like when you did it this way. That would be really helpful to me. All right. Well, thanks. I will take that. You are great. What have my stats been for last year? Well, personally, I basically run VolArb, but our strategy letter did pretty well. All right. We have a strategy letter that we put out that had, over the last 3 years, has more than doubled. So I would say that. Now, obviously, past performance is not indicative of future returns. So, but, I think that shows us that, we can, and if you think about the risk adjusted, because the big thing that we do is we have an extremely low P&L volatility. Our Sharpe ratio is extremely low. I hope you do too. And again, if you can't make it live, you will get a recording of the class as well. All right, well, I do my best. All right, any other questions, comments, thoughts? All right, I will have an email out with the recording sometime tomorrow. All right, thanks, guys. Have a good one.